It's Jared Friedman from Redwood Financial Planning. Today, I want to talk to you about the stock market and elections. Please stick around. So, what do presidential elections mean for your portfolio? Should you change your investing strategy based on who wins? You see, elections bring a lot of noise, and I wanted to dispel some market myths around the election. And the myth number one: elections usually bring big market swings. You would think elections cause major market shifts given all the politicking and intense emotions. However, history shows that elections historically don't influence market performance as much as the economy does. Growth, inflation, corporate profits, and other business and economic trends usually have a stronger effect on the stock market, not the actual vote. The president and Congress impact markets through the laws they pass and decisions they make, which are way more powerful influences than the election itself. Myth number two: markets perform better with one party in power. Now, you might have heard that markets perform better under Democrats or Republicans. However, history shows that markets have performed well under both parties. Interestingly, stocks have historically performed best under a divided government when neither party controls both Congress and the White House. Myth number three: the election cycle means I should change my investment strategy. Now, you might have heard of the so-called election cycle, where markets are supposed to follow a consistent pattern every 4 years. However, if you look back at the S&P 500 since 1950, you can see there isn't a consistent pattern to performance with both negative and positive years over time. You see, on average, markets have been generally positive each of the 4 years. But emotions are high, and changing your strategy ahead of a contested election can be tempting, but it's not a good idea. Here's the truth for you: elections are just one factor affecting markets over the next few weeks and months. Now, we can expect a lot of volatility around the election, but traders are also analyzing a lot of other things, like the Federal Reserve's path to rate cuts, and inflation and economic data, geopolitics and conflicts overseas, and much, much more. Another truth for you: tax laws and regulatory changes are going to impact markets more in 24 and 25 than the election. With many provisions of the Tax Cuts and Job Act scheduled to expire at the end of 2025, tax policies are something we're monitoring closely and going to have a bigger impact on the markets. International trade issues may also influence markets as tariffs are the talk of the town. You see, the bottom line is elections do bring uncertainty, so we're watching them carefully, but they're not the driving force on the stock market. We don't know how the election results will play out over the coming months and years. So you're staying flexible. You watch the trends and you make careful shifts when needed, not ahead of time. Thank you for watching. I wish you nothing but financial success and have a great day.